But just want to say thank you to everyone for joining us today. So today is Wednesday, May 15th, 2024. Eric mentioned this last time on the Q1 webinar, but we started these webinars back in 2020 out of necessity, really, since you weren't able to come to the office and meet with us. And we're just so happy to see that they're still going strong, and there's still so many of you who have joined us today. Also, with it being such a busy time of year, we were talking earlier, and we know a lot of you have kids and grandkids graduating, whether it's high school, college. Now it seems like there's graduation for everything: kindergarten, preschool, 8th grade, whatever it may be. But we did want to give a shout out to two of our own who are graduating. So Aaron up in Utah just graduated UVU, and to Jake's daughter, his oldest is graduating high school. Just had to throw that in there, Jake, to make sure he's
You just wanted to say how old I was is really what's going on.
a little bit, right? To throw that out there. But congratulations, both Aaron and Jamin, and to anyone else who has a graduate in the family right now. But before we get started, our usual housekeeping items here. As you guys all know by now, you come into the presentation muted and off camera, but there is that Q&A feature you can use. So go ahead, use that, ask questions throughout. Jake will help monitor that, but we'll also have a Q&A section at the end there. We have about 40 minutes or so of prepared remarks, and then we'll do that Q&A until the top of the hour. This is recorded, and we will post it to our website in the next few days. And if you do want a copy of the slide deck, just reach out to one of us, and we'll be happy to send that over. As you can see, David and Jake are joining me today. We did give Javi the day off from presenting, but don't worry, he is going to be back on screen next time in the August one. And then Eric is actually taking some well-deserved time off. He is in, speaking of travel, he is in London and Paris right now. So with that, let me go ahead, share my screen here, pull up the presentation, and David's gonna kick us off. So, can you guys see that all right?
Yep, that's great.
Perfect. So David, please tell us, what is the Fed's least favorite word?
Well, you would think that the Fed's least favorite word would be like subprime or pandemic, where they, had to step in a huge way. But their least favorite word right now is stagflation. Now, stagflation is an interesting word because you don't hear it a lot until we start to have inflation. And for many years, we didn't have inflation. But stagflation is where you have stagnant growth and you also have inflation. And the problem that you have with that is that the Fed has two mandates: strong growth, so full employment, and stable prices, low inflation. Well, if you have stagnant growth, normally you would lower rates and to try and goose the economy to get more employment. But that's exactly opposite of what you do if you've got high inflation and are trying to get it down. Now, I don't think we're at stagflation, but a lot of people are talking about it. And what you see here is this is news reports or counts, and they've jumped dramatically from back in 2022 when it first came up because we had inflation. And the concern was as the Fed raises rates, it would cause the economy to go into a recession and we'd have stagflation from that standpoint. But now let's look at the two pieces of it. Let's look at inflation to start with. And we've just updated these graphs. We've shown them before. Back in 2022, when inflation hit the 9% peak, it came down quite dramatically as the Fed raised rates and everything, and got down to like 3.5%. It looked like, oh, they're doing a great job. They're going to get it down to the 2% target. And then since then, it's sort of gone sideways. We actually had a CPI number this morning. There was sort of, a lot of the same. It was at 3.4, but just really sort of in that 3 to 4% range. The 2.71 is the PCE, which is a different inflation number, but that's what the Fed looks at. It incorporates some other things. So that's why the Fed is not, they're not able to lower rates right now. And we'll talk a little bit about that. But we've got the inflation. It's not coming down as much as they thought. Now let's look and look at what is driving that, what's causing it. And so the real, culprit in most of the inflation not coming down or coming down and then sort of stopping is the shelter costs. and that is what it costs to live in, for shelter, whether it's you're owning a home or renting a place. And what you've seen is on the rents, and we say new rents because that's if you went to a new apartment complex and say, I want to rent an apartment. You're going to pay a higher rate than if somebody that's lived there 3 years and is just renewing a lease. So new rents have definitely come down. In some areas, there are actually negative. So that's helped. But when we look at owner's equivalent rent, and that is people that own their own house, and that's about 65% of US households. And the crazy way they do that is they say, what would you rent your house for? Well, most people have no idea. But that number is coming down much, much more slowly. And what you're seeing is it's 5 to 6%. And that's way above what the 2% number is. So that's the concern that you have out there. And, is it going to come down? It will, but it's coming down a lot slower. But as you see, the owner's equivalent, which is the lighter green or blue up there, that is still coming down. It's just coming down slower than the Fed would like. So let's look at yes.
So Dave, the hope is that in the second half of the year, you start to see some of this, show up in the CPI component.
Yeah, I mean, it's going down. It's just going much slower. The rents came down quite quickly. It's just the owner's equivalent rent. And like I said, 2/3 of the people own their house, and that's where the owner's equivalent, 1/3 rents. So the rent part has come down quite quickly. It went up a lot faster, but it's come down quite quickly. It's the owner's equivalent rent, which is 2/3 of that is coming down. And you see it is coming down nearly every month. It's coming down. It's just a lot slower than the rent was.
No.
So that the hope is that it will come down, over the next 6 to 12 months. But when you look at that trajectory and how long it's taken to come from 8% to 6%, I think that's the big thing that's surprised the Fed. But if you look on the growth side, where the stagnant growth that we were talking about, where stagflation comes in, and you look at GDP, last year GDP was pretty good. I mean, you had 2.2, 2.1, 4.9, 3.3. So it was in that 2 to 3% range. And don't get caught up in the 1 quarter changes. Otherwise, you would say the third quarter of last year, that was fantastic. We were growing at 5%. The reality is we weren't. The 2% in the second quarter, 2.1, it was probably more than that. It was probably 3, but it depends upon when numbers come in. So everybody's concerned because you're looking at 1.6% for this quarter, this last quarter. And yes, that's down from 3.3, but it's happened before. And as I refer back to last year of Q2 and Q3, you merge those, average those, you say, yeah, you're at a decent 3% and more. So now if you look at the forecast for the second quarter, what you see, and the blue area, that's the range of the top 10 and the bottom 10 forecasts. And the average there is about 2% for the second quarter. If you look at the green up above, the Atlanta Fed has a model they call GDP Now, and there's actually an app for it. You can go on the App Store or on Google and find that app, and it shows every day what the Fed thinks this quarter is going to be. And they're up in the 3 to 4% range, which even if you take anywhere in between those, says the second quarter is probably 2 to 3% at least. So if that comes to fruition, then looking and saying, oh, we're going to have stagnant growth doesn't really look like that, which is absolutely astounding given that the Fed in the last 2 years has gone from 0 to 5.5%, and mortgage rates have gone from 3.5 to 7 or 8. I mean, the Fed has actually done a very good job from that standpoint. Now, if you look at one of the other metrics, and I think this is a better metric to see how the economy is doing, and that is U.S. final sales now to domestic purchasers. So it takes out imports, exports, you know, did you know, inventories go up, go down? And it just looks at what did people buy? You know, what was the total final sales? So it's not selling from a wholesaler to a retailer. It's what do the retail sales go to? And basically, when you look at it at 3%, I mean, look pre-pandemic, it's right in line. In fact, even slightly above of some of the pre-pandemic. During the pandemic and right after the bounce back, yes, the numbers were wildly lower, wildly higher. Right now, it's pretty good. Why? Well, you know, we're going to talk a little bit more, but you know, when you look at the you know, the unemployment numbers and the wage growth and stuff, most people that want a job have a job, and they're spending. Now, some people are going to look and say, yeah, but David, I heard that, you know, the credit card debt was going through the roof and that really the spending is just because their debt, they're getting in up to their eyeballs in debt. Well, here's a chart, two different lines. The red one or the blue one on the top, at the start is on the top, is household debt to GDP. So when you hear more than $1 trillion of credit card debt, sounds like a lot. But if you go back and look and compare it to GDP, it's actually right in line. In fact, a little bit lower than it's been earlier and a little bit lower than it was pre-pandemic. If you look at the red line, which is probably more important, that is looking at your debt payments, all my loan payments, credit card, car, student loans, mortgage. What is that compared to as a percentage of my disposable income? It's steady as a rock and lower than it was pre-pandemic. So when you look and say, how is the economy and the consumers? They're actually in pretty good shape. A big portion of that is because, as I go back, 2/3 of the economy is is consumer spending. Housing costs, 2/3 of the people own their own home or have a mortgage. And if they have a mortgage, it's fixed rate, their costs haven't gone up. Their wages have. So most people are better off. The bottom third that are renting, they're actually probably worse off. And that's not a good thing, but that's where we are right now. So I've talked about what the Fed's worst, word is right now. What's their next move?
Yeah, so let me touch base on this. I mean, going back to your comments, Dave, about stagflation, it just doesn't appear that we have much stagflation going on. In fact, I feel like the economy's been a whole lot more resilient than we would have expected.
Oh, absolutely.
And you know, the markets are always trying to anticipate the Fed's next move. I mean, the markets tend to be forward looking. So, I mean, when the pandemic happened, it was, hey, when are they going to raise rates? You know, after inflation started coming down, when are they going to stop raising rates? And now everybody's asking, you know, when are they going to start cutting rates? I would say the nice thing about the current Fed president, as well as the Fed officials, is they've been very transparent about what the Fed's next move is and what they're thinking. But the markets are constantly kind of jumping the gun too early. I mean, they've been wrong all along the way. I mean, a good example of that is the Fed coming into the year had hoped that, hey, we're going to be able to, with inflation falling enough, we'll be able to start to cut the rates maybe multiple times this year. In fact, they anticipated 3 times and telegraphed that. The market initially anticipated 6 to 7 rate cuts at the beginning of the year. And now we've seen that they've been wrong on that, and it's kind of moved back to where the Fed was more anticipating. So let's talk maybe a little bit about what we're hearing from Fed speakers. You know, the Minneapolis Fed president, Neel Kashkari, I mean, he made a statement not too long ago that said the Fed needs to hold rates steady for an extended period of time and possibly all year. I mean, our Dallas Fed president, Lori Logan, she said it's just too early to think about cutting interest rates. I mean, Fed officials have made it very clear that as long as inflation stays high or not down to the 2% target, they'll likely keep interest rates where they're at.
And Jake, you know, I think those statements, I think Powell is telling Fed officials, go out and start putting out there that we might not, lower rates at all this year. I think that's part of his where you talked about he's good on transparency. I think that's exactly, yeah, I mean, 2 months ago, you weren't hearing any of them say, we might not lower rates at all this year. And now you're hearing multiple ones.
Yeah. I mean, right now the market is kind of expecting 1 to maybe 2 cuts by the end of the year. So right now the Fed funds target is 5.25 to 5.5. Last time they raised rates was back in July of 2023. So it's almost been a year now that they haven't done anything. And the anticipation is by the end of the year, we'll probably see a cut or two. But to your point, Dave, it's kind of difficult to envision the Fed having any, feeling a tremendous need to cut when we've continued to see some fairly decent economic strength, right? And inflation has stayed sticky. So I think, as Powell says, it's really all about the data. But one thing that they have done that I think is interesting and has kind of gone unnoticed a little bit is the balance sheet. So over the past couple of years, we've talked about how the Fed has been doing what's called quantitative easing, when during the pandemic, they increased their balance sheet, which added liquidity to the market. And it got the Fed balance sheet got all the way up to nearly $9 trillion. And then in early 2022, they started reducing their balance sheet. Now they've reduced about $1.6 trillion up to this point. And that is a form of quantitative tightening, which is effectively sucking liquidity out of the market. It's reducing the balance sheet. And what they've been doing that by either selling or having treasuries and mortgage-backed securities roll off by about $95 billion a month. In their last meeting, they mentioned that in June, so next month, they're going to be reducing that to about $60 billion. So that will definitely be a form of easing to try to make policy less restrictive. And we'll see how that impacts things. I mean, the Fed, they directly control the short-term rates, the Fed funds rate. On the long end of the curve, long-term interest rates, they can influence those. And this is one of the ways that they influence those. Longer-term rates have certainly been increasing as of late. So, but anytime there's higher rates or this quantitative tightening occurring, it's kind of like pouring sand and gravel into the gears of a machine. You start to do that and it will slow those gears down. And ultimately, that's what the Fed is doing by having rates higher, and as well as this quantitative tightening. So I think the ultimate question comes is, are we going to get into a recession here because of that? So Karina, why don't you kind of walk us through our thoughts with that one?
Yeah, Jake, thank you so much. It's a topic we've been talking about for a while now, right? Really, since the Fed started raising rates, are they going to raise them to a point where we go into a recession? And if you were reading news articles around the end of last year, there was a lot floating around saying the most widely anticipated recession that never happened. And so there are things out there saying we're not going to go into the recession. And what we're seeing is, I'll show you a lot of good data points that are kind of alluding to the fact maybe a recession is off the table. However, there are some points that we're starting to see that are starting to worry us a little bit as we look into them. So one of the things is the global economy is still growing and showing positive growth. So if you look at this map here, what it is the green shaded areas are every country that has a positive GDP. David earlier was telling us our own GDP was 1.6 for Q1, right? And it was positive for last year. There's only, at first when I looked at this map, I saw 4 spots, but there's a really tiny one in the middle there too. So there's 5 spots here on the map that are showing a negative GDP. So again, when we look at the global economy, we are still seeing growth, which is a positive thing that shows that this recession isn't potentially happening. However, we don't want to look too rosy here and look through the rose-colored glasses. When we look at some of the headline numbers, they appear positive, but then if we take off our rose-colored glasses, look under the hood, there are some concerning factors really when it comes to the labor market. So I'm going to share some of the headline numbers that we're seeing that are really positive. But then I'm also going to go ahead and show kind of the things that are concerning us a little bit too with it. So even though this dog's really cute, we got to go look at more charts here. Let me see if I can click. There we go. And so this is the labor market. So right now with the labor market, and one of the things, as Jake was mentioning, Fed has a mandate. They want low unemployment. And we've seen that. We've had unemployment under 4% for 27 consecutive months. What this chart is showing you is down at the bottom, it goes all the way back to 1948. And the gray shaded areas are each a recession. And then on the left is the number of months we've had that unemployment under 4%. You can see that we haven't had it this low for so long since the 1960s. So that does seem to be a good thing, right? People are still employed, they're still working. The other factor that's positive with this that we're seeing is that jobs are still being created. So each month they release how many jobs were created, and in April it was 175,000. That has come down a bit, you can see, from prior months, but still at a really high level. This is where, though, we don't want it to look too rosy, and we don't want to just take these numbers as they are. We looked into them a little bit further, and this is the part that is starting to show some weakening and some concern. And it's what type of jobs are actually being created. And so what you can see here is this is full-time jobs, is that kind of coppery brown color, and the part-time jobs is that dark blue, and it's the percent change. And so right now you're seeing full-time jobs is actually negative, almost 1% change there. And then part-time jobs is positive, almost 7%. So it's more part-time jobs that are being created than full-time. When we were looking at this, one of the questions that came up amongst us was, is this because people want to work part-time though? Is this maybe people who retired during COVID, got a little bored, wanted to go back to work, or is this by choice or out of necessity? And unfortunately, it does look like a lot of this is out of necessity. There's something called the underemployment. So when you ask someone, do you have a job, but is it to the level that you need it to be? And a lot of people are feeling underemployed, meaning they're working part-time, but they need a full-time job. So that is an area that we're keeping an eye on that is starting to show some signs in a weakening labor market. However, on the flip side, more of the positive data that shows that maybe this recession is off the table. One of the big ones, we started actually the webinar talking about this, is international travel. There are so many people planning an international trip. We're at all-time highs right now when it comes to that. So this chart here, that green line is showing a vacation intended within 6 months to a foreign country. And you can see just how high it is. I mean, on our team alone, David, you just got back from Scotland, Eric's in London and Paris, and Linda is enjoying retirement and headed to Europe in a couple weeks herself. And so we're seeing this with a lot of you guys as well as with our own team. And there's still people out there spending money and traveling, which is a positive for the global economy.
And Karina, it's unbelievable if you look out for it, where we talk about inflation. But I flew from Phoenix nonstop to London and then up to Inverness in the northern part of Scotland. Round trip, that's 11,000 miles, and my ticket was $600. I mean, it's hard to believe that many miles for that. And I think that's one of the reasons you're seeing people doing it, and that's also, if you look at the sector of airlines, they're not doing very well. When they haul me around for 11,000 miles for $600, they're not going to make a lot of money. So, but it's very interesting.
Maybe one other comment to that too is that some of the reasons probably why we're seeing more international travel is because the dollar has remained really strong.
Yep.
And there's been a handful of people that couldn't go on their trips maybe that they planned during the pandemic, right? And that now they're taken now, right? So
Yep.
Yeah, I think we're seeing a lot of that too. And there's a couple articles too about the tour tourism. You have maybe seen Taylor Swift is doing her European tour, and people are flying there to go to the shows. And more people are flying for specific events, whether it's a sports game or a concert or something like that, to attend. So as long as that keeps happening too, that's definitely a positive for the economy and showing that, we're not feeling that recession, right? Consumer feels like a recession's coming. They're not spending the money on travel like that.
So we can thank Taylor Swift for the economy being better. Is that what we're saying?
We've been thanking her since last summer, I think.
Yep.
I think we had a slide on that at one point, actually. The other thing that is positive and doesn't feel like a recession is earnings season, right? The earnings we've been seeing. We're wrapping up earnings season here. There's still a couple of big companies that need to report. I know there's a lot of colors and chart bars on the screen here, but I'll walk you through them. On the left is what we're seeing for Q1 earnings for the S&P 500 is that dark blue bar. So up around just shy of 5.5% there. The light blue is if we take out some of the ones that didn't do so well, right? So we take out BMY, GILD, and PFE, and you can see it's actually 9.7%. So that's let's look through the rose-colored glasses, let's look at the positive, right? So a lot of positive there when it comes to earnings for the S&P 500. On the right, though, this is going to be where we are seeing a little bit of concern. Now, this is the expected, this isn't the actual earnings because not all of these companies have reported yet. And that used to be what we were calling the Magnificent Seven last year. We've dropped, well, not we, but the markets dropped it down to more the Fab Five, since unfortunately a couple of them got booted out. Tesla and Apple aren't on this right now, but Amazon, Google, Meta, Microsoft, and Nvidia, for their expected earnings, you're seeing a little over 64%. But if you take those 5 companies out and look at the other 495, it's actually negative 6%. We talked a lot about these companies last year and how they were driving the returns in the market. And these 5 are really still driving a lot of the earnings. I know Jake's going to talk a little bit more about what we're seeing with the market and with those as well. But again, it's something we're still having our eye on and still kind of looking at how is the earnings for all 500 companies, right? Not just these 5 big ones. But overall, I would say we're still, you've heard us say it before, probably time and time again, we're cautiously optimistic. The numbers are still strong. The economy is still strong. There's still a lot of positive there that doesn't show signs of the recession. However, there are a couple areas that we have our eyes on that are starting to weaken a little bit. But again, I think those news articles may have been right, where the most widely anticipated recession just never came and didn't happen. And so right now, again, we're feeling positive, and we'll talk a little bit more about what that means for the markets and the portfolios. But before we do that, I think it's good to look into the future. So Jake, what are some of the economic worries that we do have looking ahead?
Yeah, Karina, going back to the slide that you had mentioned on earnings growth, I think it's like 5 consecutive quarters of negative earnings growth for those other 495 companies, right? So, it's that definitely is a concern when you see that and not everything participating. But when we look at some of the economic concerns, I mean, the biggest one, there's so many, right? But whether it's, income inequality, kind of the haves and the have-nots, or it's geopolitical concerns and how that affects our economy. But I think the one that's been most front and center here lately has just been that we have a spending problem. Unfortunately, America is on an unsustainable path right now. The national debt's $34 trillion, which is greater than the size of our entire GDP. I mean, the pandemic certainly accelerated that trajectory a bit, but there's been for the last 10 plus years this kind of mismatch between spending and revenue. And that's just going to continue to get worse as you look at some of the projections. I mean, there's really 3 main drivers of that growing spending level that we're seeing. It's rising healthcare. It's the fact that America is getting older. We have an aging population. And now we have this rapidly escalating interest rate costs that continue to go up. There's 10,000 baby boomers every day retiring. And with people living longer, that continues to add to the fact that these government programs like Medicare and Social Security will continue to kind of impact those spending levels. I mean, those programs are growing faster than those tax revenues, and so that's a big impact. And then when we look at interest cost, with the national debt growing as much as it is, as well as interest rates coming from low levels to higher levels now, I mean, more and more of our budget is going to have to go to covering and servicing this debt. In fact, over the past 12 months, it's now $1 trillion that it costs for the government to service that debt. So, with interest rates likely staying higher for longer, this is just going to continue to escalate. And the problem is it starts to squeeze out other programs that the federal government has to help either vulnerable Americans or things that they could do towards, future growth, like education or research and development or infrastructure. I think also, these high debt levels that we have, cause the government to not to be able to, respond to future challenges that they might have, or potentially make it more likely that we have some type of fiscal crisis in the future. So that's probably one of the biggest things on our minds is how that gets solved. And the good news is it's a solvable problem, right? It's something that we could definitely change. We got to choose a better path, and we got to have politicians that are willing to kind of stick their neck outs and act to fix this issue, because it's going to continue to become a major issue down the road. So,
And Jake, I am confident that we've got in Washington lots of politicians that will stick up for their, what's right for America. I mean, they're just full of them there.
Yeah, that is the growing problem, right? So nobody wants to make the tough decision because it will ultimately impact their job, right?
Yep.
But let's talk a little bit about, what's driving the market this year. As Karina kind of mentioned earlier about the top 5 stocks or 7 stocks, the market was driven a lot last year by these Magnificent Seven, as we have here. On the left-hand side, you can see 2023 and where they ranked out in terms of return, as well as ranking in the S&P. 2024 is kind of been similar. We have some momentum fading a little bit with Apple and Tesla not doing so well. But the other 5 have actually done really well. And the average stock this year continues to kind of be underperforming. The market right now is up about 10-11%. We're seeing the average kind of an equal weight index with the market up only 6 or 7%. So definitely seeing some lagging among the other 495 or 493 stocks. One of the positives that we've seen too this year is that when the Fed tends to pause, when they stop raising rates and they pause in the hope of cutting, it's actually been a very positive thing for the market. In fact, the longer the pause, the better the market has done, mainly because of maybe time, right? The longer time you have, the better chance that the market goes up. But, the average Fed pause is normally about 160 days. The longest one was 446 days, and we're going on 287 days plus with the current Fed pause. And the market has performed rather well during that time. So I would say historically that's been a good thing when the Fed pauses. The thing that does worry us though a little bit is valuations. One of the measures to determine whether stocks are overvalued or undervalued is a price to earnings ratio. And that's kind of the classic measure, just showing, hey, if you have these profits at this current earnings rate, how long does it take to recoup your investment in that stock? What we're looking at here is just where is the price to earnings ratio relative to the historical trend line, and how many standard deviations is it above or below that level? So right now, we're currently overvalued. The market's suggesting we're overvalued. We're not quite as overvalued as times like, the very end of 2021, or certainly during the tech bubble. But it's fair to say that the things are overvalued. The one thing that I would mention, though, is that things can stay overvalued for a long time. I mean, think about the last 10 years. The market has gone up, over 200% during that time, but yet that entire time it was showing overvalued. So just because it says it's overvalued doesn't mean we're going to have some imminent decline. It just kind of gives you reason to be cautious when things get extremely overvalued. So I think that's just one of the things we would mention. The other thing that's kind of driving the market here recently has been some trend changes. So someone asked earlier, are we seeing any sector rotation or any change in trends? This is one trend that has piqued our interest, and we're certainly monitoring, which is kind of this debate of US versus international. We got 3 lines here. The purple line is emerging markets. The brown line is developed international markets. And then the blue line is the S&P 500. And what we've seen is over the past 1 month, international stocks have finally started to do better, something we haven't seen in a long time. The problem is when we look at year-to-date numbers, the S&P continues to be the shining star here, up about 10%, where the international markets are up about 6%. And if we go back even further and we look at 3 years or 5 years or 10 years, this is a 10-year chart. I mean, the US markets have continued to dominate the international markets. I mean, emerging markets are only up 25% in the last 10 years. So this is probably a decent time to talk a little bit about how we're allocated within our equity portfolios. We continually focus on US stocks predominantly. We don't have any international at this point. That trend that we recently saw is something we're monitoring, and if that trend continues to be favorable to international, you'll start to see us maybe allocate there. But for right now, we've continued to focus US. And then we've also focused predominantly in large cap stocks. Those are the stocks that are continuing to grow their earnings, and that's one of the reasons why we're focused mainly in the large cap space, and we definitely have a tilt to the growth end of the spectrum as well. So I think that gives a good summary of what we're seeing in the equity markets. David, why don't you walk us through what we're seeing in the bond markets?
Okay, thanks, Jake. So when you look at the bond market, as we talked about earlier, the stock market is doing quite well. The bond market generally is not. In 2022, when the Fed started raising rates, the bond market was down 13%, which was the worst in like 50 years or more. If you look at the top line, the blue line, that's the aggregate bond index, or the S&P of bonds. It's down, nearly 2%. It was down nearly 4% at one point. The copper brown on the bottom is the 20-year Treasury, TLT, which is an ETF that does 20-year Treasuries. It at one point was down over 10%. It's still down 7.5%. So that looks ugly. But as you guys know, we don't play regular bonds. Our total return income strategy is unique and has served us well. And so if you look at some of the areas in the bond market that are doing well, the top is bank loans that are up nearly 3% year to date, and then high yield, which is up about 1.5%. And we're predominantly in the bank loan side, a little bit on the high yield side, but we're up 2.5% on total return after fees this year, because we haven't done just the traditional bank loan or traditional bond strategies. And we'll continue to do that because we want to get you reasonable returns with reasonable risk. And you saw that, in 2022 and this year, where the bond market got hurt quite badly, we didn't. So we'll continue that way. And part of that is, when you look at the bond yields, yes, 1-month treasuries are 5.2, but junk bonds are 7.6. Bank loans are over 8%. And that's where we're predominantly playing. I mean, if you look at our total return bond strategy allocation, 60% is in the bank loans, which are yielding more than 8%. Now, if we start to go into recession, that will trigger us to exit some of that probably, because bank loans are their floating rate. So that, Fed raises rates or lowers rates on the long-term side, it doesn't impact it. On the short-term side, it will, but they don't go up and down in price much on rates. They go up and down in price on risk. Credit risk goes up if you go into recession. So if we avoid a recession, we'll probably stay invested in this. If it starts to deteriorate, we'll take it off the table and look and figure out where we go from there. So we think the risk reward is really good on the bond side this year. We're getting paid a whole lot more than we were over the last decade to be in bonds. If you look and are concerned about the risk in your portfolio, stocks versus bonds, give us a call. Come in, let's talk about it, because the returns that you get are predominantly based on how much risk or how little risk you take. And we always want to talk a little bit about that. But we're still, optimistic there, cautiously optimistic on the equity side. And that's sort of where we're at. Karina, why don't you start the Q&A here?
I just saw a couple questions come in, which we'll get to in a second. But there's one question we get pretty much every meeting that we have. And so we figured we'd put some slides together and just kind of address it right off the bat. And that is, how is the presidential election this year going to affect the markets, right? And what are we seeing with that? So I'll go through that first, and then we'll dive into the rest of the Q&A. We have 2 slides on this. Some of you may have seen this if you've been in recently, since we added this to our review decks. But this is really interesting, and really what it's showing is it's time in the markets that matters, not the political party that's really driving the markets. And so on the left, what it's showing you, if you took $100,000 in the last 10 years and you put it in the market, say you only invested for Democrats, which is the red line, or only for Republicans, which is the yellow, or if you just stayed invested the entire time, which is the green line. And what you can see is it makes sense to just stay in the market, right? You don't want to be making dramatic moves in and out of the market based off political party. We make moves in and out of the market, or take risk off, as we call it, based on the trends and everything else we talked about, right? What's happening in the economy? What is the Fed doing? And when you look long-term over the last 70 years, which is on the right, you can see it's just even more dramatic of a difference between it's really just staying invested in the market based off of what the market's doing, not based off of what political party. I think the other piece of this too, so that's more on, who's the president? How are you investing for that? This is more election year driven. And this is showing you that how many years that the market lost money in a presidential election year. So there's 2 pie charts here. The yellow is going to show you when the market made money. The orange is when it lost money. On the left is non-election years, and then on the right are the election years. There's only 24, so smaller sample size here, but you can see of those 24 election years, only 4 times has the market lost money. And all of those 4 times were economic event driven, not election driven. It was the Great Depression, World War II, the 2000 dot-com bubble, and then 2008 housing crisis are the 4 election years where the market lost. So with looking at that, with looking at what Jake shared us earlier about the Fed pausing, usually being positive for the market too, and looking at this here, again, we don't know what's going to happen, but there are a lot of signs showing kind of what we've been saying. We're cautiously optimistic. There's a lot of positive there, but ultimately we don't change the way we invest based off it being election year, or based off who's the president is. We're looking at what is the Fed doing? Where are the trends? Are we in a recession? Are we not? Right? All of those things we talked about are really what's driving our decisions here. So hopefully that clears some of it up, but I think now we can dive into some of the other Q&A. Let me stop sharing here so that we can see.
Maybe one thing to add, Karina, to that, just the political side, right, is, I mean, you get one side of the political party in, that certainly can affect certain sectors of the market, right? Certain, you saw it with energy, with some of the energy related bills and things like that. And one of the things that our models will do was they'll start to shift towards those things. So some of the momentum strategies that we have is a great example. There was a time where, because of the changing trends and the changing sectors, we ended up getting a lot more onto the energy side. And, that was in 2022. And then we've started to see that kind of shift where it's been more growth oriented. So even though the political parties can certainly change, and make some changes to the sectors and what sectors do well, our models will adapt a little bit to that over time just because of trends.
Yeah, and we've added, in the rotation model, we've added gold, here this year. And, whether that's related to the political side, probably not. It's probably more related to, global concerns,
Mhm.
Israeli thing, the Ukraine conflict, all of that. But they will rotate.
Yeah.
Yeah, and that one has real estate in it right now as well, which I think one of the questions we get a lot, and David, I think you can help answer this one, is about the commercial real estate side. Just what are we seeing and what's going on in there? Because I think there are some concerns about it that we've been hearing.
Yeah, that's a great question. And we do hear a lot about it. But when you say commercial real estate, that's a big area. The reality is commercial real estate, in overall, is there concern? There's concern in segments of it. So like the industrial space, warehouse, and that's going gangbusters. I mean, everybody, that's building there, that's, occupancy rates are high. The concern really has been more on the office space in downtown large cities. And that goes back to what happened with the pandemic, where it was work from home, or what has really taken over. And I don't think, maybe I'm wrong, but I don't think it's going to change the hybrid model where, okay, you work in the office 3 or 4 days and you work from home 1 or 2 days. And what that's doing, and we're seeing it, and it hasn't changed materially in the last 2 years, like in New York City. On average, only about 50% of the offices are occupied. It doesn't mean they're vacant all the time, but they're only occupied 50% of the time. One of our clients that works in Manhattan, he said, on Mondays and Fridays, you hop on the subway, it's like it's a ghost town because so many are not working in the offices on Mondays and Fridays. So
We even see that here on the 101.
On the
My
101,
commute on a Friday is so
Yep.
quick.
And so what you're going to see is more and more, companies reduce the amount of space that they need. And ultimately, I think what you're going to see is some of these offices are going to have to be converted to condos. That takes time. If somebody's got a 5-year lease on it and it's, Microsoft, they're on the hook for it. And so they may give up the space, but they're going to still have to make the lease payments. So that's going to give some of the owners time and money to repurpose that. And there will be some of them that probably get torn down and something else built there. But I think the big exposure there is to regional banks. They have lent more on office space, but I think it'll be over time, and most of the capital ratios of those banks, there'll be a few, and we've seen it, New York Community Bank, where they'd done a bunch of stuff mainly on rent-controlled apartments that they got in trouble on. But I think you're going to see most of that managed. There'll be a few that, as Warren Buffett said, you only know who's not wearing swim trunks when the tide goes out, and there will be some of those regional banks and probably some of the larger banks that will have a problem there. But I think it's not like subprime, mortgage disaster in 2008 and 9. So, and the rest of the stuff, retail space, apartment space may have some problems, but that's several years down the road, probably.
Thanks, David. Yeah, some good insights there. Jake, anything to add?
I think the big thing on real estate continues just to be the unaffordability of it, right? I mean, even with mortgage rates as high as they are, prices have not come down. Rates obviously haven't come down. it's just making it really tough for anybody that, wants to own a home, wants to stop renting and own a home. It makes it really difficult to get into that space. So I hope to see that, change a little bit, but that continues to be a major, major problem.
Yeah, if you look at the affordability where they look at the price versus interest rates, so what your mortgage payments are going to be compared to your income. I mean, most of the numbers are that it's the worst since the early 80s, so 40 years. And that was back when we had double-digit mortgage rates, and that was a terrible time. And like I said before, the haves and the have-nots. If you already have a home and you've got a 2.5 or 3.5% mortgage, or it's paid off, it's no big deal. But if you haven't and you're in your 20s or 30s and saying, I want to buy my first house, it's not a good time. It's tough.
Yeah.
Yeah. Thanks, Jake, for adding the insight to that. 2 more questions came in, and I think we should have time to answer both. One of them, this is a little more fun of a topic because we talk about this a lot, get a lot of questions on it, is what is our take on AI? And I really think, what do we see that impacting in the markets? A lot of talk is this the new internet, right? How internet changed the way we work? How's AI going to change the way we work?
Jake, why don't you talk about it?
Well, I'm just really excited about some of the, what AI is going to bring, not only to our job, but just from an efficiency standpoint that we have. I mean, ChatGPT, I mean, they've recently, introduced their new I don't know if it's 4.0 or just their new version, right? And I mean, some of the capability of that is just mind blowing for me. I mean, I saw somebody holding their phone up and they were at a park, and the AI was basically kind of describing what was being shown on the phone, right? There was a little pond and the ducks were, diving into the pond, and it was describing in real time what was happening. And I just think about the implications of that, like a blind person being able to walk down the street and hail a taxi, right? Or, I'm just really excited about the innovation from that standpoint. So I think there's good and bad things that certainly will come from this. I mean, a lot of concerns are certainly about job displacement, right? But for the most part, I think it'll just help us be more efficient in what we do.
And, when we look at it, nobody knows who the winners are going to be. I look at it as in 1900, there were 100 car companies. Nobody knew that Ford, GM was a conglomeration of a whole bunch of ones that got put together, but there were dozens and dozens that just went bankrupt. And so I think our take is that we're going to invest in ones that have a high probability of being part of that. But if we're wrong, it's not like in the .com era, oh, that company didn't end up going and so it went to zero. We're invested in NVIDIA, we're invested in Microsoft and Apple and Amazon and Google and some of those that have billions and billions of dollars worth of profit. So even if we're wrong on how they do AI, they're still going to be good companies. The job, everybody's concerned about jobs, but we have a shortage of workers in the US. And I think AI is going to allow some of those workers to be more productive so that, we don't have that shortage. There's going to be retraining and there's always pain when that occurs. But I look at it of if I've got 10 people out there with a shovel, or I've got a backhoe with an operator, yes, the backhoe with the operator is going to be more productive. 9 of those people are going to not have a job, but the one that does have the backhoe, we're going to pay him more. And those other 9, you got to retrain them. And that's the way progress works. And there will be some pain, but I agree. I'm excited about it. I think it will be a game changer over the next decade. And there's probably some companies that we don't even know the name of because they either haven't existed yet or they're private that will be the big winners.
I think with that too, the one company you mentioned was Microsoft. That really stands out to me is those of you who are still working or have your computer, you remember the days where to get Word or PowerPoint or whatever it was, you had to go buy the CD and download it. Now it's just a cloud subscription service. And so all they have to do is put some type of AI feature in there. We're already paying for it. We increase the price. And so there's a way of how many people can it touch and how quickly. So we'll probably see a lot of that. I mean, who knows? But from the Microsoft end, I think it will be interesting on how they can deploy that to so many corporations just so quickly and easily. I know we had a couple other questions come through. Oh, Jake, did you have something to add?
Yeah, I was just going to say one of the other benefits to maybe what David was talking about of owning some of these very large companies is, if there happens to be a company that does something really well and they make a ton of profit on the AI space, there's a good chance they get bought out by
Yeah.
one of these big companies, right?
Yeah.
So just because of how much cash that they have and the profits that they're making, I mean, they have the capability to buy a lot of companies like that. So
Yeah, and 20 years ago, there were 8,000 publicly traded companies. Now there's 4,000. And the reason why is a lot of them just got bought up if they were doing well. I mean, in the pharmaceutical side, I mean, all these small biotech firms, they get bought up. That's what happens. So,
and then maybe to add, I mean, we talked about a lot of the positives. There's obviously plenty of negatives too. David, I thought you brought up something worth maybe discussing just in this webinar, just about potential scams, right, that could occur from that.
yeah, I mean, you're going to see stuff, and it's going to impact a lot, where you're going to see somebody that supposedly is talking and saying something, and it looks like them, it sounds like them, yet it's not them. You will see scams where, your grandchild or your child calls desperately needing some money. Can you send it to me because I've had an accident or I've been arrested or, whatever. And there's going to be extortion of, hey, I've got this stuff and it's so-and-so that you think is an employee that's going to, ruin your company, and it's all fake. And it's going to be very difficult. It's going to be challenging. And, I mean, it's hard enough on the internet to figure out, is that person really, somebody that's in need, or is it somebody, that's in China or Russia that's scamming people for billions of dollars?
Yeah.
And it'll be all the way from give me help to this is the IRS, we're going to garnish your bank account unless you pay this $1,500 delinquent tax that you haven't. And if we don't get it by tomorrow, we're going to file tax liens against you. I mean, that's what's going to happen.
Yeah. With everything.
So just like anything, right? There's the good and the bad. And I think we just need to be cautious, but also excited for some of the productivity and changes that it brings.
No, absolutely.
I know there were other questions that came through, but we are actually at the top of the hour here. And so if you do have additional questions, just give us a call. We are happy to continue this conversation one-on-one. I think the other thing too, little plug here, we're coming up on halfway through the year. Summer months, I know a lot of people end up traveling, but if you have time to fit it in, please give our office a call, set up a Zoom, set up an in-person meeting with us. We'd love to do a little mid-year review and check on things like your taxes, your portfolio allocation, all of that. So hopefully we see some of you this summer. And if there is anything else, please just give us a call.
And have fun.
Yeah,
I guess that too. Yeah.
Yeah.
Thanks, everyone.
All right.
Thank you.
Bye-bye.